we're gonna go over the bookkeeping basics and tax for you as a TpT seller. A little bit about myself. I am the CEO and founder of ND Accounting and Tax Services. I started this since 2019, helping business owners like you with their tax compliance and bookkeeping, as well as payroll and sales tax services. So I kind of do everything, trying to give business owners clarity and to help them grow in their business. I hold a bachelor's in accounting as well as an MBA from Florida International University. My favorite game is Scrabble. So I play that with my kids all the time. I enjoy relaxing at the beach and I love dancing. So in the agenda today, we're gonna talk about bookkeeping basics, how your TpT income is taxed, all about estimated tax, tax compliance, paying yourself from your TpT business, and as well as tips to reduce your tax liability. And so hopefully I bring some insights and I can answer some questions that you probably had in the back of your mind before about bookkeeping and taxes. I know that it can be a very complex, confusing subject for many. And that's where I come in to really help clarify those questions that you have. So talking about bookkeeping basics, so bookkeeping is the process of recording your business transactions and organizing them in a consistent way so that it provides you with a clear picture of your financial situation to enable you to make important decisions to grow your business. So it's important to have your bookkeeping in a very consistent way. So you can have a chart of account where you have different categories and you use those same categories every time and not changing from one category to another category, because then it becomes very, very chaotic and you don't understand your numbers. So the goal of bookkeeping is really understand the story of your books, right? Understand, because it's all about what those numbers mean and to help make those decisions that you need to grow your business, and to understand what you need to do to improve, and etc. So it's very important to track your income. I don't know if all of you, how many of you are doing your own bookkeeping? No. Okay. So you need to be able to track your income. And for that, you can have different buckets for your income, the sales that comes. So let's say you sell courses, you sell digital products. So depending on what exactly you do with your TpT business, or if you have, I know that some people sell on TpT and some people also sell on their own platform, on their own website. So you want to make sure to categorize properly and so that you understand exactly where you're making the most profit, where you should improve, if you need to advertise more in one area, etc. So tracking your income as well as tracking your expenses will help having an organized book. So you also want to make sure you keep track of you keep all your receipts as proof, because everyone is subject to audit. So you want to make sure that you have those receipts, because the bank statement is not enough, okay? Because looking at a bank statement, you will see the line items in your bank. Sometimes it just gives the name and the amount, but it doesn't say exactly what exactly you purchased. Especially like you purchase something on Amazon, you will see Amazon and then the amount. but what exactly was it for, right? So that's where a receipt comes in play. It's very, very important that you keep all your receipts, all your documentation, in case you are audited. And even for you also, right? It's a good way to make sure that you don't miss any expenses, that everything is accounted for. You also want to separate your personal and your business finances, in the sense that you have one bank statement, one bank account for your business and one bank account for your personal, so that you don't commingle your business and personal finances. Especially if you have a limited liability company, you can lose the liability protection just by commingling the funds. So, very important. And then you also want to make sure that you use an accounting system such as QuickBooks or Xero. There are so many different accounting systems nowadays that you can use to make sure that you categorize all your transactions properly. Using Excel is fine as well, but I find it very, it's clean, having an automation. You have your QuickBooks where you can link your bank account and making sure that all transactions are accounted for. Whereas if you do a manual bookkeeping, sometimes you may forget one transaction, especially if you have different bank accounts. You may have a checking account, a credit card account where you that you use for business reasons. So you want to make sure that you connect all these accounts into QuickBooks if you're using QuickBooks or any other accounting software. That way you have all transactions in one place. And then if you need to, well, later we'll talk about how to pay yourself in your business, but paying yourself, is another very important aspect where you separate your personal. It's like having your personal life separate from your business life. The next point is having a budget and review your business financials on a regular basis, because you don't want to be driving a car and not knowing where you're going, right? So you want to plan, you want to have a budget that you visit on a regular basis, and that you also go over your financials, because when you don't go over your financials, if there's an error, if there's a bank error, if there's a bank fraud, whatnot, and then you wait till the end of the year to go over everything, then it's kind of too late to contact the bank to say, okay, I see this transaction from January 2025. This is not a transaction that I made. Whereas if you keep track of your financials on a regular basis every month, you look at your financials to see where you're at, then you can catch those mistakes, those errors, or any fraud that could potentially happen, especially nowadays with all these scams. So make sure you have a budget, make sure you review your financials on a regular basis to see, for example, what is your business strength? What is your business weakness? And that will allow you to make those important decisions to see, okay, do I have enough, or can I hire some help, right? Etc. And hiring a professional is very important as your business grows and as it becomes more complex, because the more you grow, the more your business make, the more it's gonna be complicated for you to do your own books, especially if you elect to be taxed as an S corporation. You have to present a balance sheet. If it's not your area of expertise, you will not know certain things that a professional knows. Okay. Any questions so far?
I have a quick question.
Mhm.
I guess my question is, if someone in this group is going to set up a separate bank account for their business, what do they need to bring to the bank to set up that, like a DBA or an
Okay.
account for the business?
Okay, so you need to have an EIN. I always recommend to have an EIN, even if you are a sole proprietor, because the EIN basically is protecting your social security number, right? If you give your social security number, then everybody has access to your social security number. So having an EIN is very important. So if you have a DBA, you want to open the account in the name of the DBA to have that separation between your personal finances to your business finances. So first, okay, so let's say I'm gonna talk about the different entities a little bit later, but say you don't have an LLC yet, everything is under a DBA or everything is under your personal name. You wanna bring the DBA, the EIN number, or if you have an LLC, the name of the business, they're gonna ask you for the state registration if you have an LLC, the EIN, and that way you have all that documentation and they'll be able to open the bank account in the name of the business. If you also want to to have a credit card, I know that sometimes it can be a little bit more complicated to open a credit card in the name of the business, to have business credit, but try to, as best as you can, build business credit. But I know that it's very often easier to have a credit card on in your personal name. But if that is the case, use that credit card only for business purposes. You know that, okay, this specific card, I'm not gonna use it for the business. But if you are able to open a business credit card, it's better. That way it's in the name of the business, and everything is really separated. Okay. Any other question regarding this slide? Okay, so let's go to the next. So how your TpT income is taxed. So everybody, I don't know if some of you are still teaching. Yeah, okay. So your business income is taxed depending of the category, the classification of your business, okay? So your activity can be considered a hobby. It can be considered you can be a sole proprietorship, a partnership, a limited liability company, a corporation, etc. So there are more entity classification, but these are the most common ones that I'm talking, because there's LLP, there's different other ones, but these are the most common. So we have a hobby. It's very important to know in which bucket you fall in, because you are taxed differently depending on the bucket you belong to. So if your activity is considered a hobby, you will be taxed differently. So what is a hobby for the IRS is primarily carried out for pleasure and enjoyment, and you have no intention of making a profit. So this is what the IRS considers a hobby. And the criteria to determine if you have a hobby or a business is, some questions that the IRS asks: do you carry out the activity in a business-like manner? Meaning that, do you have business cards? Do you have a business website? Do you have separate books, like a bookkeeping system? So all of these, if they see that you are carrying the business like any other business person, then you are most likely in business, you most likely have a business. Or do you put the time and effort into the activity to make a profit? Or do you change the methods of operation to improve profitability? Or if you have losses in the business, Are they due to circumstances that are out of your control? So all of these criteria, they look at to see if you actually have a business or if you have a hobby. Because if you misclassify the type of income that you have, the IRS can and sometimes does that. They reclassify from business to hobby. And, so it's very important to know where you belong. So yeah, you may have a hobby where, okay, once in a while you make a profit, but that was not your intention, and you don't carry that activity in a way to make the profit. That was not your primary intent. And sometimes also they look at, are you relying on that income to live, right? Some people, they retire and they just want an activity just to have an activity, or just because they want to make an impact and they don't really care about the money. So it's a hobby. But if you're really pursuing it to make an income, then you have a business. Okay. The other category is a sole proprietorship. A sole proprietorship, your business is not registered with the state, is the easiest type of business to have, where you decide to be in business, then you are in business, right? You don't register with the state, it's not incorporated, but it's easy. And you can open a DBA. A DBA, it's not a legal entity. A DBA is a doing business as, just so that your name is not out there, but you have a DBA. It's not a legal structure. You are still a sole proprietor. The partnership is also the second easiest way to form a business. So two people come together and they decide they want to create a business, share the profit and loss, then you have a partnership. Then it's not registered with the state. It's just like a sole proprietorship, but instead of one person, it's two people or three or four, right? So that's also very easy to put in place. Then you have the limited liability company. This is to offer a sort of protection to protect your personal asset in case someone was to sue your company, then they cannot go after your personal asset. But there is a way also, as I mentioned before, if you commingle your personal finances and your business finance, you can lose that limited liability protection. So you want to make sure that you separate your business life from your personal life, to ensure that you don't lose that limited liability protection. Okay. So a limited liability company can be a single member LLC or a multi-member LLC. So single member LLC, as the name says it, is one person, or you can have like the partnership, 2 or 3 people deciding to come together to share the profit and loss of a business, but this time they register it with the state, then you have a multi-member LLC. Even when you decide to have a business with your spouse, okay, it's still considered a partnership in the eyes of the IRS. Especially in the states like Florida, where you have the common common law, right? So it is considered a limited liability it is considered a partnership, and they have to file a partnership return, because in many cases I've seen people where they thought that they didn't have a partnership because it's with their, they opened a business with their wife or with the husband, and they didn't realize that in the eyes of the IRS, it's a partnership, because the IRS will issue a letter to tell you that what type of business. When you receive the EIN, usually the EIN letter states what type of what tax form that you need to file. And in there, usually when you have two members, regardless if it's one spouse, two spouses, then the IRS will ask you to file a partnership return. The next category is a corporation. Usually when you register with the state, you say you want to open a corporation. When they say corporation for usually is a C Corp. S Corp is different than C Corp. So S Corp is not a legal entity. S Corp is a tax election that you make. So let's say you have a limited liability company, you decide that to reduce your tax liability, you want to open an S corporation. So first you open an LLC, then you make the election to be taxed as an S corporation. Just like a C corporation may elect to be taxed as an S corporation, just to avoid the double taxation. Okay, so C corporation also offers the liability protection. Okay, and they usually share the profits with their shareholders, and it is the best type of structure to raise capital. Okay, so now we're gonna talk about how those different entities are taxed. So for the hobby, you cannot deduct any expenses. Okay, so all your expenses, so that like the subscription, the fees from TpT, the software, whatever it is, you cannot deduct any expense because the IRS consider that you do not have a business, and only businesses can deduct expenses, business expense. So the hobby is reported on the Schedule 1 of your personal tax return of your and it is gonna flow to your 1040. And you can only report the gross sales of your TpT income. Okay, so that's the hobby. And then the sole proprietorship is taxed, so it's taxed on your personal tax return. Okay, you will be subject to federal income tax as well as self-employment tax. You will report your income and expense on the Schedule C, and it's gonna flow to your 1040. So you are taxed on the net income, so which means your gross sales minus your expense. So when you have the report from TpT, it's not the net amount, not the payout that you receive. It's very important because I've seen many cases where when someone reached out to me to do their bookkeeping and they were doing their own bookkeeping in the past, they record the amount incorrectly in the books because they record based on the money that come in from the bank account. So the bank account is gonna reflect the net payout, right? Not the gross. So you need to look at the sales report to determine how much is your gross sales, because you need to report the gross sales on your tax return, and any fees that TpT takes out is gonna be deducted as an expense. Okay, it's gonna be a deduction. Now for limited liability, let me talk about the partnership first. So the partnership, you're gonna have the income and expense reported on a partnership tax return. So there's gonna be two tax returns. There's gonna be the partnership return and the individual tax return. So the partnership, the income and expense, the sales that you receive from TpT and the expenses will be reported on the 1065. And the partnership is gonna issue a K-1 to each partner for their portion, for their share of the income and loss, right? Of the profit or loss, okay? So this is for a partnership. And for a limited liability company, so as I said before, limited liability company can be a single member or multi-member LLC. So if it's a multi-member LLC, it goes back to the partnership rule where you have a 1065 and you receive a K-1. Each partner receives a K-1 to report on their personal tax return, and that's where the taxes will be the tax liability will be reflected on the personal tax return because the partnership does not pay the income tax. Okay, it is only paid at the personal level. I hope I make sense, that it's not too, complex, but I'm trying my best to make it as clear as possible. And then for a limited liability company, so if it's a single member LLC, that means one person, it's only you. You will also report the business income and expense on the Schedule C. So it's considered a disregarded entity if you did not make the S Corp election. Okay, so if it's not an S Corp, if the LLC is not taxed as an S corporation, it's gonna be a Schedule C, just like the sole proprietorship. The same rules apply. There's gonna be the federal income tax and self-employment tax. And then the S Corp, if you make the S Corp election, okay, usually that election is made to save on taxes because once you make that election, you don't have that self-employment tax anymore, although you will be paying a little bit of payroll taxes based on the salary. So I'll explain more about that, but once you make the S Corp election, you will be subject to federal income tax on your personal tax return because just like the partnership, the S Corp doesn't pay the income tax. So there's gonna be two tax returns, the 1120S. So for the S is for small businesses. So you consider a small business when you make that election, small corporation. Okay, so you're gonna have the 1120S where you report the business income and expense. That the same way as a partnership, there's gonna be a K-1 to the shareholder if there's only one owner. So there's gonna be one K-1. If there are 3 owners, there's gonna be as many owners as there are. There's gonna be a different K-1 for each. And those K-1 is gonna be used to file the personal tax return and to pay income tax. And the difference with the single member LLC or sole proprietor, you no longer have the self-employment tax that is being eliminated. Okay. So there's going to be only federal income tax, but you may be subject to capital gain tax if, in addition to the salary, because when you make the S Corp election, you are required to run payroll. So meaning that your S Corp is gonna issue paychecks to you, right, through payroll. It's a requirement. So once you have that, you will pay payroll tax on that reasonable salary. And then you can also take distribution. Distribution is like money that you take out from the business. They call that distribution. But if you take more than you were supposed to, aside from the salary, and you take money out from the business, right? If you take more than you were supposed to, you will be subject to capital gain tax, meaning that you take more than distribution than your basis. Your basis means it's like you're having your capital accounts. So it's what you put in as contribution when you just started, plus any profit that the business made that is retained in the business, that instead of taking the money out, you leave it in the business. So they call that retained earning, minus any money you take out, which is distribution. So if the total is negative, so that means you took too much distribution than you were supposed to, you will be subject to a capital gain tax, okay? Because sometimes when you look at your bank statement, you think you have money, not taking into account what happened in the past. So let's say you had a loss in the prior year, that could cause your capital gain, your capital account to be negative because you take more money than you were supposed to. Then you will be subject to that capital gain tax. But if you do not take more than you were supposed to, that tax is completely eliminated. You will only be subject to federal income tax. Any questions so far?
I have a question if nobody else does. It's about the hobby. What would the advantage, like, why would somebody claim their business as a hobby? What's the upside to it?
Well, it's not claiming your business as a hobby. Really, it's going by the definition. It's going by the intent. What is really your intent when you set up the TpT? Because some people may, okay, I do it once in a while. I go on TpT and set up my product, but it's not really my intention to make a profit out of it. It's like a hobby. A hobby, what is a hobby? A hobby is because you enjoy it, because you know, between cooking, between teaching, it's like your relaxation time, right? That you create a digital product and you put it in the TpT platform to sell. So it's really the intent that define whether you have a hobby or a business. The business is always going to be better because you can deduct all your expenses with the business, whereas the hobby, you're not able to deduct any expenses. If you make a loss, you will not be able to deduct that loss either. Versus a business, you make a loss, you have, you are able to deduct that loss. If you have any expenses, which usually you do, because there's some ads, there's the website hosting, there's the membership, the TpT membership, the Canva subscription, so you can deduct all that when you have a business. Whereas when you have a hobby, it's a one-time thing. You don't do it regularly. So you cannot deduct those expenses.
Perfect. Thank you.
No problem. Okay. But the IRS does look at that and they can reclassify if you put it as business and it's not really a business, because they look at if year after year after year, you always have a loss, that means you're not really putting the effort to generate a profit. What's the point of having a business if 5 years in a row, 6 years in a row, you have a loss, right? You would call it a quit, right? If year after year, you're making, your intention is like, I want to make a profit, right? But year after year, you're having losses. So what's the point of having a business to have a loss every single year, right? But you need to make all the effort to make it work. If it's at stake, if you're relying on that income to survive, you would do everything that you can right? It is under your control. Whereas a hobby, it's not, it's beyond your control, because if it's a business, you're gonna do everything. You're gonna take courses. How can I improve my marketing strategy? How can I, make my website better? So you are conducting yourself as a business person versus someone who has a hobby, doesn't really care about, taking courses, making it better, et cetera, et cetera. Okay. Any more questions on that? All right, so let's move to the next slide. So estimated taxes. So the income tax is a pay-as-you-go system where the IRS expects you to make estimated payments as you earn the income, okay? As you make money throughout the year, it is expected of you to make quarterly estimated tax payments. So you can do that either by by sending a check to the IRS, which I don't recommend. I usually prefer that you go on the IRS website and make those estimated payments. The estimated payments include the federal income tax, self-employment tax, okay? And you can do that, let's say, if you have an employment and a job, you can also ask to withhold more money if you don't want to be bothered by going online and making those, making those estimates. And you can ask your employer to increase your withholding through the W-4 that you fill out, to take into account that business income, okay? Either way, it has to be paid because the IRS assess penalty and interest when those estimates are not made. Even when you pay those estimates late, they will assess those interests and penalties. So interests are calculated every day. So it's important to make those payments. And the other thing to know is that when you, okay, so coming April 15, let's say you file your tax return on time, or you decide to file for an extension because you don't have all the data, or your stuff are not organized, or you're missing some tax forms. When you file the extension, the IRS also expect you to pay your full balance due, even if you're gonna file the tax return in October. So you file the real tax return in October 15 or prior to that. They give you 6 months extension to file, but the actual balance of the tax return is expected to be paid by April 15. And let's say you wait till October to make those payments, interests are accumulating every single day up to the point that you make that full payment. And how much to set aside for estimated tax? I would say 25 to 30%. Okay, this is to cover your self-employment tax, and it's 15.3% self-employment tax, which is basically, it's for FICA, which covers Social Security and Medicare. So when you are an employee of a company, the employer pays half and you pay half of Social Security and Medicare. But when you are self-employed, you have your own business, you have your own TpT store, you pay both the employee portion and the employer portion. And this sometimes can be pretty high, and that's where the S Corp election really helped and saving on taxes. So you need to account for the self-employment tax as well as your federal income tax. Okay, and depending on where you are located, you may also have to make estimated tax payment for your state. Okay, so it's technically about the same logic for state. You need to make estimated payments as well. And if you make the S Corp election, so you are considered an employee of your company, you need to make, you can, again, either make those estimates online, or you can ask to withhold more money from your paycheck as an employee of your business when you receive the paycheck from your business. Okay.
Nirva, do sole proprietors have to pay the quarterly estimated taxes?
Yes. Sole proprietor, sole proprietor, or a single member LLC, or how you call that? Partnership as well, multi-member LLC. I don't remember if I mentioned that the C corporation, the C corporation pays their own tax. Okay, so C corporation are expected to make estimated tax payments as well. So when you have a C corporation, the C, so that there's going to be the 1120 for the C corporation where they file and pay their tax. In addition to that, when they issue dividend to the shareholders, so once they make a profit, the business makes a profit, they split that profit to give to their shareholders through dividends. So when they receive those, when the shareholders receive those dividends, they are also taxed on those dividends. So that's where there's the double taxation of the C corporation. And the C corporation can also elect to be taxed as an S corporation, just like the LLC can elect to be taxed as an S corporation. Okay, when they want to avoid the double taxation, they do that S Corp election. At that point in time, once you make the S Corp election, there's gonna be an 1120S where the S corporation filed the tax return, but the S corporation is not subject to federal income tax. The S corporation pass the profit or loss to the owner or to the shareholders through a K1, and the shareholder or owner pay the income tax at the end personal tax return level using the K1. Okay. Okay. Now, paying yourself from your TpT business. So, of course, if you have a hobby, there's no such thing as paying yourself from the business, right? You just have the money, and because it's gonna be a one-time thing. It's not something that you're not looking to make a profit. It's once in a while that you receive some money. So it goes to your personal account and you use it. But say you are a sole proprietor, or you have an LLC, you're a single member LLC, or even a multi-member LLC, okay? You want to write a check from the business account to yourself. So the business is paying you, okay? And that's how it's considered an owner's draw. So that's it. So you cannot receive a salary when you are a sole proprietor or a single member LLC who has not made the S Corp election. No salary, no paycheck. It's just a draw. You take money from the business to yourself, but make sure you do not pay your personal rent from the business account. This is where I was saying to separate business from personal. If the business is making money, you need some money for yourself. issue a check from the business account to yourself or transfer from the business account to yourself. And that's that. It's considered a draw, okay? You do not pay your personal car with the business account. You do not pay your personal rent with the business account. Even if you have the home office expense deduction, anything that is under your personal name is paid with your personal bank account. If you have to take the home office expense deduction, after you pay your rent with your personal account, you pay your utilities, etc. When it's tax time, you give that information to your tax preparer. And based on the allocation, because there's going to be a percentage that is allocated to the home office based on the square footage of the office and the square footage of the entire home. That's how they determine, but the money has to come from your personal account because your rent is under your personal name, or your home or your mortgage is under your personal name. So do not use the business account for personal expenses, okay? The other way to take money out is you write a check and you notate this as a loan. You want if you want to pay, to pay back that money to the business. So you consider this as a loan, but this has to be done properly. It's as if you were going to a bank to ask for a loan. There needs to be a notes payable stipulating the interest rate, the repayment schedule, etc. When they say a loan, the IRS see a loan as a loan. There should be an interest rate allocated to that loan, and there should be a schedule showing exactly every month you're gonna pay principal plus interest to the company. So the best way, the best route is, because usually people don't do it. So the best route is to do an owner's draw. So you put money in, it's gonna be on, your contribution to the business, your investment to the business. You put money out, it's gonna be considered a draw. For an S corporation, on the other hand, since it is a requirement that the owner of the S corporation have a reasonable salary, a reasonable compensation based on your function, based on what you do in the business.
Okay.
Sorry?
Okay.
So
You're good. Keep going.
okay, so based on what you do in the business, or based on, so let's say what they mean by reasonable compensation is, if you were to hire someone to delegate, to give, to do what you're doing in the business, how much would you pay that person, right? You're not gonna pay the whole profit to that person. You're gonna look at their experience. You're gonna look at how much they pay in this area for that job, for that function, etc. So that's why the IRS want to make sure that you pay yourself a reasonable salary. You're gonna run it through payroll. You're gonna pay payroll taxes. It's recommended that you use a payroll software, or you hire someone who knows how to, professional, knowledgeable professional to run payroll for you, so that you receive on a regular basis a paycheck from the business. Okay, so that's one form. In addition to the salary, you can also take distribution, meaning that from the remaining profit of the business, you can take money out, and it's called a distribution. And you write a check from the business account to yourself, you annotate it as a distribution, and that's that. Okay, and it also has to be tracked in a way that you don't exceed your capital account so that you don't pay that capital gain tax. Nobody wants to pay more tax. And lastly, the C Corp, again, you are the owner of the business, you work in the business, you are considered an officer who's working. So the C Corp is also gonna pay you a salary for working in the business as an officer. And then the profit, the remaining profit, you'll receive a dividend from the company. So when it's an S Corp, it's called a distribution. When it's a C Corp, it's called a dividend. Okay. And as a shareholder, you will receive a 1099 DIV for a dividend from the company to file your personal tax and be taxed on that dividend. Okay. So this is how you pay yourself. Remember, you are a sole proprietor, a single member LLC, you didn't make the S Corp election, you do not receive a salary, do not run payroll through those payroll software to yourself. I insist because I see that too many times.
Nirva.
Yes.
Oh, well, okay. So I sent you a private message, but I'm just gonna
I'm
interrupt for
sorry.
1 second.
Oh, too
Does
long?
everybody in the group know whether they are a sole proprietor? Has anyone not a sole proprietor, like you have an LLC or a C Corp or an S Corp? Joan, what do you have?
I'm Canadian, so it's like none of those. But
I forgot.
it's limited, something limited. It's like a numbered entity.
Okay, so everybody else is a sole proprietor, right? Lynette, you haven't incorporated?
I am an LLC.
Okay, you are an LLC. Okay, good. But no
Yeah,
one
and
else
I got
is.
my EIN.
Okay, but you haven't made the S corporation, the S corp election, correct?
No, not yet.
Oh, okay, because it's not for everybody, okay? The S
Yeah.
corp election is not for everybody. If you reach a certain level in profit, in net income, you may consider the S corp election. But if your company is at the beginning stage where you know money comes little by little, it's you know you're not at, like, let's say you make a net profit of 60,000, then you can consider an S corp election to save on self-employment tax. But if you're below that, I do not recommend, because there's gonna be additional costs like running payroll. You have to pay to run payroll for you. You're gonna have a separate tax return. So there's gonna be two tax returns, the S corp plus the individual. So the S corp tax return is usually the fees to prepare that is usually way more than the individual tax return. So be mindful of that too.
Nirva, should everybody, says they all said they're a sole proprietor, but you know our business is like all online. Is there a benefit to us becoming LLCs?
Yeah, the benefit is to protect yourself if someone were to sue you. You know, these days, if you have that protection, it does not hurt.
Is it possible to get sued when you're just selling a digital resource?
I mean,
I know anything's possible, but
people sometimes are a little cray, so
yeah.
I don't know. That happens, yeah, but that is to just separate. You do not have to, right? A lot of people, what they do at the beginning, they are sole proprietor, and as their business grows, they want to have that protection. And also, if you want to ask for a loan, or you know, you want to show that you really have a business, it's recommended to have an LLC, right? In the eyes, like if you need a grant, if you need a loan, the bank will see that you have a separate entity from yourself, a legal entity from yourself. So yeah. That's
Okay,
the
I have one more question for you.
Mhm.
Oh, thank you, Joan. Um, so I don't remember why I'm doing this because I once was an S corp and then I went back. But I'm just a sole proprietor now, but I don't pay my quarterly estimated taxes. How am I doing that and not getting in trouble? Is it
Okay, for sure, you need to look at your 1040. For sure,
uh-huh.
they calculated a penalty and interest for not making estimated tax payment, depending on the level of income. So if you're making a loss, so you have nothing, if you don't have any tax liability, because
Yeah.
the penalty and interest is based on the tax liability. They calculate it based on the tax liability. So if you don't have a
Mm,
tax liability, then you don't have any penalty and interest. But if you do have a tax liability, they take when I say tax liability, I don't mean what you owe in April. It's the line where it says tax, total tax. So there's a line that says total tax, and there's, if you have a W-2 income, it shows the withholding. And then after the withholding, you have either balance due or refund. I'm not talking about that line. I'm talking about the overall tax, right? So if you have an overall tax, and you didn't have withholding. So if, let's say you have a W-2 income, you increase your withholding, then it's taken care of. So you will not owe any penalty or interest because it's taken care of through the withholding because you increase your withholding to take into account your business income. But if it's not the case, for sure, you're being penalized and you have interest as well. Look at the last line of your 1040. I'm pretty sure that you're paying a penalty
I bet I am.
and you don't even know about it.
Gosh, okay, yeah, no, I'm really glad you said that. So how do we pay our estimated taxes? Where do we go? Do we just go to irs.gov?
irs.gov/payment, and you make
Okay.
your estimated thing there. And usually when they prepare the tax return for you, they will look at prior year tax liability. If you pay 100%, it depending on your income, sometimes once you pay 90% of your prior year tax liability, then you will not be penalized. Although the interest will still accrue, you will not have the penalty, but up to the point that you make the payment, you may have interest, right? So they will look at what was your prior year tax liability, and then if you make 90% of those payments, you may not be penalized. And depending on your income, sometimes you have to make 100% or 110%, depending on how much your income was. So there's a bracket for it. So
Okay.
yeah.
So,
But look at that last line. I'm sure that you'll see penalties from 20 to 10. You'll see the penalty calculation there.
okay, so I know I cut you off there. I'm sorry. Do
That's
you want to just because we're coming up here at a little after
I'm
9 already. Do
sorry.
you want to just go ahead and anything else you want to say, wrap it up? Because I do have a couple
Okay,
more questions
yeah.
I want to
Anyways,
ask before you
everybody,
run
you will
away.
have that presentation. So this is the last, no, I'm sorry. The last slide was about the different tax forms. That if you have consultants, designers that are working for you, you need to make them fill out a W-9, because if you pay them more than $600 or $600 and more, you need to issue them a 1099 NEC. You will receive a form 1099-K from your TpT platform. If you make for 2025, the threshold again change. So if you made $20,000 in gross sales, or for certain states, it still requires $600. So if you make for certain, depending on the state you are, they may issue you a 1099-K if your gross sales was $600 and more. If you're not part of those states, so the threshold for you is gonna be 20,000. However, you are still required to file a tax return if you make at least $400 in gross sales. Not because you didn't receive a 1099-K you made $600, you made, let's say that you made $500, okay, in gross sales, you didn't receive a 1099-K, but your gross sales was $405, you have to report, you need to file a tax return. Okay, if you make less than $400, you may not have to file a tax return, but if you make $400 and more, you need to file a tax return. Okay, and the other tax forms are W-2 and payroll tax forms like 941, 940. This is more like you need to have a payroll provider to file those for you. So if you had any employees, okay? W-4 is for if you're an employee of your S Corp or you had employees, you make that employee fill out the W-4. Sometimes if they want to adjust their withholding during the year or when it's close to the end of the year so that they don't owe too much in taxes, they may fill out that W-4 form and give it to you to adjust their withholding before it's too late. Okay, so technically everything is there.
Nirva, if we're hiring somebody for our business, like a virtual assistant
Mm-hmm.
or a social media manager or something, we have to collect a W. What do we collect from them? A W-4?
W-9, W-9.
A W-9 or an I-9?
No, okay, so depending, if it's an independent contractor, okay, where they provide services to different people, it's not just you, they're not your direct employee, they have to give you a W-9 because that W-9 is gonna, you will use that W-9 to issue a 1099 because you don't issue a 1099 and EC form if that person has an S corporation, for example. So let's say you hire a consultant to design your website, let's say, and you don't know that that person has an S corporation that had made the S corp election. You just see ND Accounting and Tax Services LLC, right? But you don't know that I made the S corp election. The only way to know is when the person present to you that W-9 form where they have to specify on that form if they are an S corporation, a partnership or whatnot.
And do we have to do that with every person we hire, or if it's over $400 or $600?
You issue that 1099 form if you pay them more than $600 and more. But how will you know from the beginning that you will not pay them $600 throughout the year?
Right.
You may hire now and then you keep on using their service throughout the year, and so it's recommended that you every time you hire someone, you make them fill out that form. If that person is not an employee, it's W-9. If that person is an employee, it's W-4 and I-9.
Nice.
Okay. So too bad there's not enough time to cover everything, but you'll have those slides here. I mentioned tips to reduce your tax liability, before it's too late. Now that we are at the end of the year, you want to look at your withholding, you want to look at your deductions and your business deductions to make sure you take into account everything. You want to make sure you have the right business structure and you look at your retirement and stuff, okay? And here I put a list of deductions for you. And if you are still teaching, you also can deduct $300 of classroom expense. If you're working for an employer and they haven't reimbursed you those classroom expense like supplies, computer, software, courses, and there's no double dipping. If you take a deduction for your business, you cannot double dip. It's one or the other. And if you are married, if your spouse is also a teacher, instead of $300, then you can claim up to $600. And that's it. Yay! So yeah, so this is my information. I'm more than happy that, if you have any questions, you can reach out to me. If you need a consultation, if you're not sure that you did your tax correctly last year, I can look at your previous year's tax return, and going forward, we can do things differently for 2026. So here's my contact information. Feel free to reach out, email, okay, so if you want to call, because of all those scams, I don't answer my the phone. Just leave me a voicemail and I will get back to you, because there are too many scams. And or you can simply send me an email. I will answer if you send me an email. Or also that I have a link tree that has all my, there's my calendar link also. But if you go to the website, you'll see my booking calendar there as well. Oh, one thing that I want to mention, my website is being redesigned. So don't be surprised if you see my website like today you go and you see my website one way, and then a week from now you see it's completely different. We are doing a rebranding, so it's still me.